Let me ask you something. You've done the work, you've researched the funds, you've built an income portfolio that generates meaningful monthly distributions. The deposits hit your account like clockwork, and on paper, everything looks great. But here's the question that most income investors never ask until it's too late. How much of that income are you actually keeping after taxes? Because here is the uncomfortable reality that the income investing community does not talk about nearly enough. Two investors can own funds with the exact same yield, the exact same distribution amount, and the exact same total return. And one of them can walk away, keeping significantly more of that income than the other, simply because of how their fund is structured from a tax perspective. Not because of anything they did, not because of clever tax planning on their part, but because of decisions made at the fund construction level, decisions about which type of options to use, how to handle gains and losses within the portfolio, and how the distributions get classified when tax season arrives. This is the world of tax-efficient income investing. And today on Dividend Desk, we are going all the way in. We are covering everything you need to know about how the most tax-efficient covered call ETFs are actually built, specifically the mechanics of Section 1256 index options and why they matter so much for your after-tax returns. We are breaking down return of capital, what it actually is, why it is genuinely different from return of principal, and why most investors have it completely backwards. We are going to demystify 19A1 notices, those monthly disclosures that confuse so many income investors and often lead to completely wrong assumptions about tax treatment. And we are going to walk through what your 1099 actually tells you and how to read it correctly. This is a longer, more technical video than our usual content. But I promise you, if you are an income investor holding covered call ETFs in a taxable brokerage account, this information is worth real money to you. Let's get into it. Disclaimer: nothing in this video is financial, investment, or tax advice. I am not a financial advisor or a tax professional. Everything here is for educational and informational purposes only. Please always consult a qualified tax professional for advice specific to your own situation. Part 1. Why tax efficiency matters more than most income investors realize. Let's start with the big picture, because I think a lot of income investors underestimate just how much taxes can affect their actual take-home returns from covered call ETFs. When most investors evaluate an income fund, they look at yield. They look at total return. Maybe they look at NAV stability. These are all important metrics. But almost nobody looks at the after-tax yield, the number that actually reflects what ends up in your pocket after the IRS takes its share. And the reason this matters so much for covered call and option income ETFs specifically is that these funds are generating income through mechanisms that can be classified in wildly different ways for tax purposes. Some of that income can be taxed at ordinary income rates, the highest rates on the tax schedule, the same rate as your paycheck. Some of it can be taxed at long-term capital gains rates, which are significantly lower for most investors. Some of it can be classified as return of capital, which defers the tax entirely to a future date and potentially converts it to long-term capital gains treatment. And some of it can be a blend of all three. The difference between a fund that generates primarily ordinary income and one that is structured to maximize long-term capital gains treatment and return of capital can be enormous on an after-tax basis, especially if you are investing in a taxable brokerage account where you cannot shelter that income inside a Roth IRA or 401k. Here is a simple illustration. If your fund distributes $10,000 in income in a year, and that entire distribution is classified as ordinary income, and your marginal tax rate is 32%, you owe $3,200 in taxes. Your after-tax income is $6,800. But if that same $10,000 is classified as long-term capital gains, taxed at 15% for most investors, you owe $1,500 in taxes. Your after-tax income is $8,500. That is $1,700 more in your pocket from the exact same distribution, purely because of how the fund is structured. Multiply that difference across years and across a larger portfolio, and you are talking about a genuinely significant impact on your long-term wealth. This is why tax efficiency at the fund construction level is not a minor footnote. It is one of the most important factors in evaluating any covered call or option income ETF. Part 2. Section 1256 Options, the Tax Efficiency Engine. So how do the most tax-efficient covered call ETFs actually achieve better tax treatment? The answer for many of the leading funds in this space comes down to one specific regulatory category, Section 1256 contracts. Here is what Section 1256 means and why it matters. Under the U.S. tax code, certain types of options contracts receive what is called 60/40 treatment. This means that regardless of how long the fund held those options, whether it was 1 day or 1 year, 60% of the gains from those options are automatically taxed at the long-term capital gains rate, and 40% are taxed at the short-term rate, which is ordinary income. Think about what that means in practice. A fund that trades options frequently, rolling positions monthly or even weekly, as many covered call strategies do, would normally generate entirely short-term gains because none of those positions are held for more than a year. Short-term gains are taxed at ordinary income rates, the highest rates available. But if those options qualify as Section 1256 contracts, you automatically get 60% long-term treatment on every single trade, regardless of the holding period. That is a massive tax advantage built directly into the instrument itself. The specific options that qualify for Section 1256 treatment are index options. Options linked to broad market indexes like the S&P 500 index or the NASDAQ 100 index. These are exchange-traded, deeply liquid instruments, and because they are cash-settled, meaning when they expire, you receive or pay cash rather than taking delivery of the underlying stocks, there is no risk of your underlying equity positions being called away in the event of a large market move. That cash settlement feature is actually another significant practical advantage beyond just the tax treatment. This is why the most thoughtfully constructed covered call ETFs lead with index options wherever possible. It is not just about tax efficiency, though that alone is compelling enough. It is also about liquidity, settlement mechanics, and the elimination of assignment risk. When you can check all of those boxes with a single instrument, you lead with that instrument. Now, not every fund can use index options for every exposure. Some underlying assets, certain sectors, individual stocks, commodities, Bitcoin, do not have qualifying index options available. In those cases, fund managers have to work with other instruments. But the hierarchy matters. Index options first, then ETF options structured as flex options where possible, and only then other instruments like single stock options or equity-linked notes when nothing else fits. Part 3. What equity-linked notes actually are and why they cost you more in taxes. Speaking of equity-linked notes, this is something I want to spend time on because a lot of income investors do not fully understand what they are buying when they own a fund that uses ELNs, and the tax implications are significant. An equity-linked note, also called an ELN, or sometimes referred to as a swap agreement or structured product, is essentially a legal contract with a bank. The bank agrees to provide you with a return linked to some underlying asset, and in exchange you are taking on the creditworthiness of that bank as a counterparty. From a tax perspective, ELNs are treated as fixed income instruments, essentially as interest payments, and interest payments are taxed at ordinary income rates, the highest rates on the tax schedule. There is a holding period rule that theoretically allows for better treatment. If you hold the ELN for more than 53 weeks, it can potentially qualify for long-term treatment, but most option-based strategies are rolling their positions far more frequently than that, which means ELN income almost always ends up as ordinary income. Compare that directly to the Section 1256 index option approach, 60% long-term gains, 40% short-term, regardless of holding period. The tax difference for the investor can be very substantial. But beyond the tax treatment, there is another risk with ELNs that many investors completely overlook: counterparty risk. When you own a fund that uses equity-linked notes, you are dependent on the bank that issued those notes to honor its obligations. The bank has to have a balance sheet large enough to make good on those contracts. And we have seen in recent memory what can happen when major financial institutions run into trouble. When Credit Suisse collapsed and UBS stepped in to absorb its liabilities, investors in Credit Suisse-linked instruments were only protected because of that intervention. If UBS had not stepped in, those notes could have been marked to zero regardless of what the underlying assets were doing. That is not a theoretical risk. That is something that happened within the last few years. Index options traded on a regulated exchange do not carry counterparty risk in the same way. They are exchange-cleared instruments. There is no bank counterparty that can fail and take your investment down with it. For a long-term income investor building a portfolio they intend to live off of, that distinction matters. Part 4. Return of capital. The most misunderstood concept in income investing. Now let's tackle the concept that I think causes more confusion among income investors than almost anything else. Return of capital, or ROC. I cannot tell you how many times I have seen investors in forums and comment sections reacting negatively to return of capital classifications on their distributions, treating it as a red flag, assuming it means the fund is giving back their own money, interpreting it as evidence that the fund is not generating real income. And I understand where that instinct comes from. The phrase return of capital sounds like the fund is returning your capital to you. But in most cases with option-based income strategies, that interpretation is completely wrong. Let me explain what return of capital actually is in the context of a covered call ETF. Option-based strategies generate income primarily through capital gains, specifically the premiums collected from selling options. Capital gains, by definition, are not net investment income. Net investment income is dividends and interest. Since option premiums are capital gains rather than net investment income, they get classified differently for tax purposes. And through a process of pairing realized gains with realized losses within the fund, a portion of the distributions can be reclassified as return of capital. Here is the mechanism in plain language. When a covered call fund sells options and those options increase in value against the fund, which happens during strong bull markets when the underlying asset runs up past the strike price, the fund closes those options at a loss and rolls into new positions. The equities in the fund have gained value, but the options closed at a loss. The fund uses those option losses to offset gains elsewhere in the portfolio. When those losses exceed the gains in a given period, the result is that the distribution gets reclassified as return of capital. What does that actually mean for you as an investor? Two things. First, instead of paying taxes on that distribution right now at whatever your current rate is, you defer the tax to the future. Second, and this is the key, the distribution lowers your cost basis in the fund. If you paid $50 per share for the fund and you receive a $1 distribution classified as return of capital, your cost basis is now $49. If you eventually sell that fund after holding it for more than a year, that gain from basis reduction gets taxed at the long-term capital gains rate. You have effectively converted what might have been short-term ordinary income into a long-term capital gain, taxed at a lower rate, deferred to a future date of your choosing. That is not a bad thing. That is genuinely good tax engineering. Return of capital in this context is a feature, not a flaw. Now, and I want to be very precise here because this distinction is critical, there is a completely different concept called return of principal that is genuinely problematic. Return of principal is when a fund literally takes the money you invested and hands it back to you as a distribution. Your capital base shrinks. The fund's ability to generate future income shrinks alongside it. You receive a distribution, but you are actually poorer for it on a net basis, especially once you account for the taxes you owe on that distribution. This is what happens in over-distributing funds, and it is exactly what we talked about in our previous video on NAV decay. Return of capital, from the gains and losses within an options portfolio, is not the same thing as return of principal. One is smart tax management. The other is a slow liquidation of your own portfolio. Knowing the difference is essential. Part 5. 19A1 Notices, what they are and why you should not rely on them. Every month that a covered call ETF pays a distribution, you may see something called a 19A1 notice posted on the fund's website. These notices cause a remarkable amount of confusion among income investors, and I want to clear that up completely. A 19A1 notice is a regulatory disclosure required by the SEC. It is not a tax document. It is not a prediction of your tax liability. It is not an accrual of what your end-of-year tax classification will be. It is a monthly snapshot disclosure that is required whenever a fund distributes income that includes something other than standard net investment income. Here's the important nuance. A 19A1 notice is prepared by the fund's administrator or accountant based on the fund's book-level investments for that single month. It looks at a one-month snapshot and estimates what the tax classification of that month's distribution might be. But it does not, and cannot, account for what the fund will do for the remaining months of the year, how markets will perform, or how the fund's gains and losses will ultimately net out by December 31st. This creates a real problem for investors who take the 19A1 notice and try to extrapolate it forward as a forecast. If a fund's 19A1 notice in January shows 80% return of capital, it is tempting to conclude that the full year will also be 80% return of capital. But that conclusion is not justified. Market conditions change. The fund's trading activity changes. What looks like 80% ROC in January could end up being 30% ROC by the time the actual 1099 is issued in February of the following year. We have seen investors make this exact mistake, planning around a ROC percentage they read on a monthly notice, and then being completely blindsided when the actual tax classification came out very differently. The right way to think about 19A1 notices is as a rough directional indicator at best, and a required regulatory disclosure at worst. They are telling you that some portion of the distribution is not standard net investment income. That is all. Do not use them for tax planning. Do not use them to forecast your year-end tax liability. Do not adjust your withholding or tax payments based on them. What should you use instead? The 1099 div that your brokerage issues after the end of the tax year. That is the authoritative document. That is where the actual, final tax classification of every distribution you received during the year will be reported, broken down into ordinary income, qualified dividends, long-term capital gains, short-term capital gains, and return of capital. That is the number you bring to your tax preparer. That is the number that matters. Part 6. Understanding your 1099. Reading the document. That actually counts. Since we have established that the 1099 is the document that matters, let's spend a moment making sure you know how to read it correctly in the context of covered call ETFs. Your 1099 div from your brokerage will show several different categories of income. For a straightforward dividend-paying stock fund, most of that will fall into ordinary dividends and possibly qualified dividends. For a covered call ETF, especially one using Section 1256 index options, the breakdown is likely to be more complex. You may see a portion classified as ordinary income. This is taxed at your marginal rate. You may see a portion classified as qualified dividends. These come from the actual stock dividends generated by the equities held inside the fund, and they receive preferential long-term capital gains tax treatment. You may see a portion classified as long-term capital gains. This comes from the 60% long-term treatment on Section 1256 options, and you may see a portion classified as return of capital. This appears on some platforms as a non-qualified dividend or in a return of capital box, depending on how your custodian reports it. One important note. The 1099 your brokerage issues reflects the tax classification for your specific holding period, not the fund's full year. If you bought the fund in March and the fund has been running since January, your 1099 will only reflect the distributions you received during your holding period. It may look different from the fund's published full-year tax information because your slice of the year is different from the fund's entire year. This is why it is always worth having a conversation with a qualified tax professional when you are holding covered call ETFs in a taxable account, especially in the first year of owning a new fund where the tax character of distributions may be harder to predict based on limited historical data. Part 7. How long should you hold a covered call ETF for tax purposes? This is a question that comes up frequently, especially for investors who are thinking about trading in and out of covered call positions rather than holding them long-term. Let's walk through the key considerations. For the Section 1256 index options held inside the fund, the 60/40 tax treatment applies regardless of your holding period. You do not need to hold the ETF itself for 365 days to get the benefit of the Section 1256 treatment on the options component. That 60/40 split is built into the instrument and applies to every distribution, whether you have held the fund for 3 months or 3 years. However, your holding period of the ETF itself still matters for other components of the return. If you buy an ETF at $50 and sell it at $51 after 6 months, that $1 gain is a short-term capital gain taxed at ordinary income rates, exactly the same as any other investment you sold in under a year. Where holding period becomes most important is for the return of capital component. If a portion of your distributions was classified as return of capital, meaning it lowered your cost basis from $50 to $49, and you sell the fund before holding it for 365 days, that basis reduction could generate a short-term capital gain on sale. But if you hold the fund for more than a year, that same gain converts to a long-term capital gain at the preferential rate. The general principle: for most income investors whose primary goal is sustainable long-term cash flow, holding covered call ETFs for more than a year tends to maximize the after-tax benefit. The combination of Section 1256 treatment on the options, potential return of capital reclassification, and long-term holding period on any appreciation works together most effectively over time. But, and I cannot say this enough, please talk to your own tax advisor before making decisions based on any of this. Every investor situation is different. Your tax bracket, your other income, your account type, your state tax treatment. All of these factors affect what the optimal strategy looks like for you specifically. Closing. Let's bring it all together. Tax efficiency is not a minor consideration for covered call ETF investors. It is one of the most important and most overlooked factors in determining your actual, real-world return from these funds. And the differences between funds that are thoughtfully engineered for tax efficiency and funds that are not can be genuinely significant on an after-tax basis, especially in taxable brokerage accounts over long periods of time. Section 1256 index options are the gold standard for option-based income generation from a tax perspective. The 60/40 treatment, 60% long-term capital gains, 40% short-term, regardless of holding period, is a structural advantage that directly benefits your after-tax income. Funds that lead with index options wherever possible are giving their investors a meaningful edge that compounds over time. Return of capital when it comes from the gains and losses dynamics of an options portfolio is not a warning sign. It is a tax deferral mechanism that can convert ordinary income into long-term capital gains. The confusion between return of capital and return of principal is one of the most common and costly misunderstandings in income investing. Learn the difference and do not let it trap you. 19A1 notices are regulatory disclosures, not tax forecasts. Do not plan around them. Do not use them to project your year-end tax liability. Read them for general directional awareness and wait for your 1099 for the actual numbers that matter. And always involve a qualified tax professional when you are managing a meaningful income portfolio in a taxable account. The details of how these instruments are taxed are genuinely complex, and the stakes are high enough to warrant professional guidance. At Dividend Desk, we are committed to covering every dimension of income investing that actually affects your financial outcomes. And taxes are one of the most important dimensions that most channels in this space are not giving the attention they deserve. If this breakdown was useful, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community. The link is in the description below, where we go even deeper on topics like this and discuss what we're watching, what we're researching, and how we're thinking about building durable income portfolios in real time. This is Dividend Desk. We'll see you in the next one.